Well, good afternoon, everyone. I'm absolutely delighted to welcome you to this afternoon's webinar from members of the Public Law and Regulatory Group of 39 Essex Chambers, wherever you may happen to be watching this. My name is James Strachan, and my specialist areas of practice include financial services and regulation. And I'm joined by two colleague barristers in Chambers who you will hear from shortly. You have Gethin Thomas, who has a broad practice across public and commercial law with a particular focus on financial services and regulation. And amongst other things, he's acted as a consultant counsel to the Financial Ombudsman service, and he has particular experience of advising on pension issues. And Gethin will give you the first presentation on some of the regulatory responses to COVID-19 and timetable changes affecting financial services. And then second, you'll hear from David Hopkins. David's practice spans commercial and public law with a particular interest in financial services. He's regularly instructed by financial services customers, firms and regulators to provide both advice and advocacy. And before joining the bar, he worked for the city, in the city for 5 years in derivatives structuring, and that brings some practical experience with him to his legal work. David, I'll just explain, David's going to cover the FCA test case on business interruption insurance, and also what we've described as the elephant in the gloom, currently somewhat in the shadow of events that we have at the moment, but the looming challenges of Brexit, and we can consider whether we might be emerging from one crisis in due course into another. But you'll also hear something from me at the end about how COVID-19 related complaints may affect the Financial Ombudsman service. And so while some of people might consider this to be something of a specialist topic area, the reality is that it covers a dauntingly large area. And in the spirit of this 45 or so minutes webinar, to try and avoid Zoom fatigue, this is necessarily going to be a somewhat selective and idiosyncratic overview of events. And we're highlighting areas of particular interest to us and potential big issues in the coming months. We're not going to cover in any detail procedural issues of conducting litigation during COVID-19 restrictions, such as remote hearings, because that's ground that's been covered in some depth elsewhere, and there are many practice directions that abound. So we're really going to focus on the effects of COVID-19 on the delivery of financial services and complaints. Just to explain that there is a question and answer function on your screens. It probably is towards the right-hand side at the bottom, which allows you to ask questions, and we can either give answers already if we have the chance, or even potentially type some answers. Please do ask any questions you want about the presentations at any stage, and we will try and answer as many as we can of them, time permitting. And just please feel free to send any feedback or comments you may have using that function. I'll aim to bringing things to a close after about 45 minutes, but the webinar is being recorded, and you will be able to see it again or catch up on anything you missed out on the 39 Essex Chambers website, along with the slides we're presenting, and that will be on the website from tomorrow. So without any more ado, I will hand over to Gethin to give you the first presentation.
Thank you very much, James. Good afternoon. So as James flagged, I will be addressing how the FCA, the PRA, Bank of England and the Pensions Regulator, as well as very briefly the Financial Ombudsman service, have responded to the COVID-19 crisis and how the regimes have been adapted. I will also address, in overview, what extensions, delays and relief have been afforded in dealing with the knock-on impacts of COVID-19, and it will be, especially to avoid Zoom fatigue, a whistle-stop tour through some of the key developments over the last 10 or so weeks. Britain's financial services sector had suffered a drop in profits and spike in bad debts even before the coronavirus lockdown. For example, the quarter-one CBI PwC Financial Services Survey painted a disappointing picture for the sector, with banks, insurers and fund managers already reporting a drop in optimism over the 3 months prior to March, amid then just rising concerns about the COVID-19 pandemic. And as you'll appreciate, the actual economic shocks from COVID-19 have already been profound. And the FCA has noted in particular that COVID-19 is causing unprecedented levels of uncertainty in financial markets. So by way of an overview as to what the FCA have done by way of responding to the crisis, the FCA have issued guidance as to the issues listed on the slide. And just to pick up a couple of these in a little more detail. First, with regard to firms' responsibilities and operational resilience. So the FCA has stated that it expects all firms to have contingency plans and that the plans have been tested. Alongside the Bank of England, the FCA is actively reviewing the contingency plans of a wide range of firms. And by way of ensuring operational resilience, it has stated that, as a practical example, the firm has to close a call centre, requiring staff to work from other locations such as their homes. The firm should establish appropriate systems and controls to ensure it maintains appropriate records, including call recordings, if required, and that applies as a general principle. With relation to SM and CR responsibilities, the FCA has notably softened aspects of its senior managers and certification regime to minimise the burden on firms during the coronavirus crisis. It does not require firms to have a single senior manager responsible for their coronavirus response. Firms should allocate these responsibilities in a way which best enables them to manage the risks that they face. And the FCA advises that firms should review its statement on key workers specifically that it made on the 20th of March, and its recommendation that the SMF1 or the most relevant member of the senior management team be responsible for their approach to key workers where appropriate. The regulator said that it will not enforce the requirement on firms to submit updated statement of responsibilities if changes to staff were in response to the pandemic and would only be a temporary shift. Moreover, in normal circumstances, the 12-week rule allows an individual to cover for a senior manager without being approved, where the absence is temporary or reasonably unforeseen, and the appointment is for less than 12 consecutive weeks. But if this temporary arrangement lasts longer than 12 weeks and is as a result of a pandemic, firms can notify the FCA, and that arrangement can be extended for up to 36 weeks. Perhaps it almost goes without saying that in any event, the FCA has explained that it expects firms to clearly document these responsibilities, however temporary, including on relevant statements of responsibilities and on the responsibilities map. Interestingly, in an interview with the Financial Times at the end of April, the FCA interim chief executive has said that the coronavirus pandemic is posing the first serious test of these senior management rules, which were introduced after the financial crisis in 2008, particularly in the context of bailout loans, and acknowledged that the ability of the FCA to take action over a lender's behaviour remained limited. And he said that he was monitoring how banks were handling the rollout of the government's bailout loan scheme, in particular after there had been reports of concerns made by companies and politicians. Notably, the FCA has issued a number of Dear CEO letters targeted particular high-risk sectors and issues, and I'm going to very briefly discuss 3 of them. Historically, Dear CEO letters have only been used fairly sparingly by the FCA, although even before the COVID-19 crisis hit, the FCA had issued a number of letters in January and February. So the first Dear CEO letter, sent on the 31st of March, it was to firms providing services to retail investors about COVID-19. Not unsurprisingly, the FCA notes that it's received hundreds of requests for adaptations to its regulatory approach, and the key aspects of the letter advises that it is introducing flexibility on the following requirements. First, as to flexibility on client identity verification. Whilst the FCA states that it expects firms to continue to comply with their obligations on client identity verification, firms can be flexible, including using remote verification. And the FCA expressly suggests that clients can use selfies or videos, for example. Secondly, flexibility is introduced over the best execution until end of June. The FCA made clear that it has no intention of taking enforcement action where a firm does not publish its RTS 27, RTS 28, or Article 65(7) reports, provided that they are published by the 30th of June 2020. And thirdly, there is flexibility over requirements governing 10% depreciation notifications until the end of September this year. Again, the FCA have made clear that it has no intention of taking enforcement action where a firm first has issued at least one notification to retail clients within the current reporting period, indicating their portfolio has decreased in value by at least 10%. And secondly, subsequently provides general updates through its website or other public channels such as social media on market conditions generally, explaining how clients can check their portfolio value and invite clients to contact the firm if they wish. Or thirdly, they can choose to cease providing 10% depreciation reports for any professional clients. The second Dear CEO letter was sent to lenders to small businesses on the 15th of April 2020. The activity of lending to an SME largely sits outside the FCA's scope. However, the FCA reminds lenders to ensure that it complies with the senior managers and certification regime, and makes clear that the FCA wants to ensure that there is not a repeat of the well-documented historic issues in the treatment of SMEs. And thirdly, the FCA have written indicating that it received credible reports of a small number of banks failing to treat their corporate clients fairly when negotiating new or existing debt facilities as clients navigate the current exceptional circumstances. The FCA explains that its concern is that tying clients to take additional services or demanding fees for services not provided is not in the best interest of those clients, distorts competition, undermines market confidence, and calls into question firms' and individuals' integrity. The FCA is expressly concerned that this conduct is likely to increase overall transaction costs for corporates trying to raise money in these circumstances. So it will be important to ensure that firms do review their current systems and controls, particularly regarding the identification and mitigation of conflicts of interest and the handling of inside information where applicable. The FCA have also issued a number of delays and extensions, which are outlined on the slide. Just very briefly to pick up one in particular, temporary measures to extend deadlines for regulatory reporting. The delays are relatively short, related to the handbook being either 1 or 2 months as applicable. The FCA has recently made a statement on the Corporate Insolvency and Governance Bill. By way of a very brief background, the bill is intended to provide businesses with the flexibility and breathing space that the government recognises they need to continue trading during the pandemic. The next stage in the legislative process of the bill is the second reading in the House of Commons, which is due to take place next Wednesday. The measures are relatively broad, and the government has explained that it is designed to help UK companies and other similar entities by easing the burden on businesses and helping them avoid insolvency during this period of economic uncertainty. With regard to financial services regulation in particular, the FCA has drawn attention to a number of important provisions. The first being the company moratorium. And the bill proposes to create a moratorium during which most legal actions cannot be taken or continued against the company without leave of the court. This is obviously a very significant measure. However, employment tribunal proceedings or a claim between an employer and worker may be instituted or continued without leave of the court. It's important to note, however, that under Schedule 1 to the bill, a company is not eligible for the moratorium if it is an insurance company, bank, investment firm, or investment bank, by way of example. Moreover, debts or other liabilities arising under a contract or other instrument involving financial services, such as a securities or commodities contract, and there are further specific examples in the bill, are excluded from the moratorium payment holiday. As such, there are fairly hefty carve-outs which prevent financial services from benefiting from this moratorium to the same extent as companies in other sectors. There are 2 further points noted by the FCA. The first is the suspension of ipso facto termination clauses, and the second is the temporary suspension of wrongful trading provisions from 1st of March 2020 for 3 months. And the bill also included temporary flexibility in respect of AGMs and filing requirements with Companies House. On 20th of March 2020, the Bank of England and PRA made a joint statement announcing a number of measures in response to the pandemic. These are listed on the slide and included cancellation of the bank's 2020 annual stress test, amendments to the biennial exploratory scenario timetable, and the bank made a statement on the IFRS 9 and COVID-19. The IFRS 9 sets out a framework for determining the amount of expected credit losses that should be recognised, and it requires that lifetime expected credit losses be recognised when there is a significant increase in credit risk on a financial instrument. The PRA published a further letter to the CEOs of UK banks on the 26th of March, providing further guidance on the treatment of payment holidays and similar schemes offered by banks and building societies on all loans, not just those limited to government-endorsed payment holidays on mortgages, as well as economic forecasts used in calculating expected credit losses in terms of IFRS 9. In particular, PRA notes that the economic shock is expected to be temporary, although the duration is uncertain, and it advises that forecasts used to calculate probability of default and loss given default are expected to assume a quick return to long-term economic trends. Firms should also avoid double counting between any adjustments for COVID-19 and existing adjustments for other uncertainties such as Brexit. And the unprecedented conditions require greater reliance on post-model adjustments and high-quality governance, and this should be applied to overlays and adjustments. And there's also been a postponement of the joint Bank of England FCA survey into open-ended funds. And just to flag briefly, there have been a number of further key statements made since, which have addressed the following, set out on the slide. And on the 7th of May, there was another joint statement by the Bank of England and PRA, which announced changes to resolution measures. And in particular, the dates for the major UK banks and building societies to submit their first reports on their preparations for resolution and publicly disclose a summary have been extended by a year. These firms will now be required to submit their first reports to the PRA by October 2021 and make public disclosures by June 2022. Now, the Pensions Regulator has recognised that there are a whole range of issues that pension trustees, employers and their advisors are facing as a result of COVID-19. It's worth noting in particular that the Pensions Regulator have stated that the impact of COVID-19 heightens the need for trustees to understand the corporate health of their defined benefit scheme sponsoring employer and consider any previously drafted contingency plans. And it provides guidance to trustees as to specific questions to the scheme sponsoring employer where they're in corporate distress. And there is joint guidance that has also been published collectively by the relevant regulators dealing with pensions issues, which is also important to have regard to. Last, but certainly not least, the FOS. James will speak, as he indicated in the introduction, on the FOS in more detail. But just very briefly to note that the Financial Ombudsman Service has observed that it is already experiencing a high demand for its service. And in a letter to the FCA on the 16th of April, the Chief Ombudsman explained that it will take account of the FCA's revised expectations of what constitutes compliance with its rules, guidance and standards, as well as good industry practice at this time. And this includes guidance which gives firms additional flexibility to help them deal with difficult conditions. Finally, and very briefly, there are two very discrete statutory instruments to note. The first establishes the COVID Corporate Financing Facility, or the CCFF, which provides funding to large corporate businesses by purchasing commercial paper of up to 1 year maturity. And the second removes from the scope of consumer credit regulatory regime loans of £25,000 or less that are made by commercial lenders to sole traders, unincorporated associations and partnerships of fewer than 4 people under the Bounce Back Loan Scheme. And the effect of this instrument is that these types of loans will be an exempt credit agreement. So by way of summary, the regulators and the Financial Ombudsman Service have responded fairly swiftly to some of the challenges that have been posed by the COVID-19 crisis. And I'll now hand over to David to deal with some of those in more detail.
Gethin, thanks very much. I'm just going to share my screen so you can see the slides that I have. And I'm going to be speaking, as James already indicated, about business interruption insurance and the FCA's test case. then moving on to everyone's previous favourite topic, which is Brexit, very briefly at the end. So hopefully now you can see my slides. And as I say, my first topic is on business interruption insurance. This has been something of a hot topic. You'll have all seen stories in the press of the thousands of businesses around the country who've suffered from the coronavirus and lockdown situation, which has interrupted their businesses. I don't think there's any argument that their businesses have been interrupted, but many haven't been able to get coverage. That's because typically the standard policies only cover losses caused by physical damage at the property. And it's highly unlikely, of course, that COVID-19 counts as physical damage. And I don't think there's going to be any serious disputes that such a policy should cover any losses which have been incurred as a result of the lockdown or as a result of COVID-19. However, it's also fairly common in the industry for there to be a non-damage extension to a business interruption policy, which doesn't require physical damage at the property to respond. And those wordings have developed over time, and they included quite a large number of triggers, but the ones which are most likely to be relevant for COVID-19 and lockdown are common ones which are likely to be relevant are denial of access to the property or interruption as a result of a notifiable or infectious disease. And I'm going to give you some examples of wording from a real policy taken from a policy published by the Hiscox Action Group, which is a group of around 450 businesses who have policies with Hiscox, who are currently in the process of initiating some joint arbitration and litigation. The first one is a denial of access clause. Now, this purports on the face of the policy to respond where there is an incident occurring during the period of insurance within a 1 mile radius of the insured premises, which results in a denial or hindrance in access to the insured premises imposed by any civil or statutory authority or by order of the government or any public authority for more than 24 consecutive hours. And then in the case of notifiable disease, the policy should respond in the event of your inability to use the insured premises due to restrictions imposed by a public authority during a period of insurance following an occurrence of any human infectious or human contagious disease, an outbreak of which must be notified to the local authority. Now, I take these examples as they're ones in which an insurer has denied coverage, relying on the policy wording. But at the same time, I don't think it's unreasonable for the policyholders to argue, or perhaps even to have thought prior to the event, that they would be covered as a result of COVID-19 and lockdown. Now, of course, policy wordings differ widely amongst all the different policies, and none of them are going to be identical or necessarily identical to the ones we've just seen. In particular, the meaning of notifiable infectious disease can vary quite widely. In some cases, a policy may well refer to a specific list of diseases which are declared within the policy to be notifiable or infectious. But that is very unlikely to cover COVID-19 since it wouldn't have been around at the time the policy was drafted. Others may refer to the statutory definition of notifiable disease. Now, COVID-19 has been a notifiable disease in a statutory sense since 5th of March this year. So it may well be that those policies do include such a disease. But at the same time, that extension may expressly carve out a pandemic, which may be designated by the WHO or another suitable organisation. Going back to the first definition, the denial of access clause, you may recall, and you may also be able to look at the slides again tomorrow if you need your memory refreshing on this point, but it included a geographic radius. It said that it was an incident occurring during the period of insurance within a 1 mile radius of the property. And the question is, would COVID-19 or lockdown actually satisfy that requirement? Does there have to have been a case in the vicinity of 1 mile of the premises? Or could the incident possibly be interpreted as occurring within 1 mile since lockdown is occurring effectively across the entire country? Other sources of uncertainty are in causation. If we take an example of a business which has had to close due to a confirmed case of COVID-19 at its premises, then it seems quite likely that its business interruption insurance policy would respond to losses caused by that closure. Going to the notifiable disease clause again, it was an occurrence of any human infectious or human contagious disease which must be notified to the local authority. But that does not mean that the policy would respond to all of the losses which have been caused as a result of subsequent lockdown. It may well be that on construction, on its true construction, the meaning of that policy is that it simply responds to the losses that are incurred by the initial closure and any cleanup that is required as a result. So there's a lot of uncertainty among businesses and insurance firms and brokers too, as to whether the policies that have been sold prior to the lockdown, prior to COVID-19, should actually respond. Unsurprisingly, the insurers themselves have taken the view in the majority of cases that the policies don't respond. But clearly the policyholders, many of whom will be suffering significant depletions in cash flow, are keen for their policies to respond. All of that uncertainty led the FCA to have to take a response. And its first response was to provide a Dear CEO letter on 15th of April this year. And in that letter, among other things, the FCA stated that its view was broadly in line with the industry's. And that, as it's quoted there, our estimate is that most policies have basic cover, do not cover pandemics, and therefore have no obligation to pay out in relation to COVID-19. While this may be disappointing for the policyholder, we see no reasonable grounds to intervene in such circumstances. However, that wasn't a very satisfactory response from the perspective of the policyholders, obviously. And the pressure has been increasing. As I mentioned already, there's the Hiscox Action Group, and there's also a trade body of restaurants and bars who are making quite a bit of political noise. The FCA has had to go much further, and fortunately, they did so fairly quickly. Within 2 weeks, they'd announced that they will be bringing a test case. When they made that announcement, they reiterated their view that most policies would not respond, but accepted there were key issues causing uncertainty, in their words. And it really is that uncertainty which has required this response. A policyholder may well be disappointed if they're told by a court that their policy doesn't respond, but at least they have the certainty at that point, and they can start looking to other ways to try and save their business or to cover the cash flow, such as through the business interruption loans and so on. And the uncertainty really hampers business. So it is very welcome that the FCA has responded in the way it has done. What it said is that it's going to go to court to seek declarations on an agreed and urgent basis. Now, the precise parameters of that are not yet clear, but it's reasonable to expect that the declarations being sought will be as to the proper construction of policies and whether they've been triggered. The FCA said it will submit a representative sample of policy wordings. And by agreed, what they mean is that the basis on which the declarations will be sought is to be agreed with insurance firms who are taking part. The press, in particular Reuters, has indicated that the FCA is aiming for a hearing in July 2020, so it shouldn't be too long before we get the certainty that is desired so widely. And the result would obviously be binding on firms involved, but only in respect to the representative sample that was in front of the court. Having said that, it would obviously be highly persuasive in other cases, especially where wording is broadly similar or potentially even identical, even though they were not part of the representative sample. However, the test case will give no consideration of quantum. As I say, the parameters are not certain, but what has been said is that there will be no consideration by the court of how much a certain policy ought to pay out. It's most likely that it will simply be a case of the proper construction of the wording and a declaration as to whether the policy should respond. One point that may give people pause for thought is whether or not this decision could be appealed. And I don't see any reason in principle why it couldn't be appealed. But given the basis on which the declarations are being sought, that is on an agreed basis, it seems very unlikely in practice that anyone would appeal this decision unless there was a truly fundamental error at first instance. The FCA gave opportunity to insurers, policyholders and brokers to make representations, but those deadlines have now passed. The insurers had until 15th of May and the other parties, the policyholders and the brokers, had until 20th of May. There have been no further announcements since that time, but what the FCA is doing, presumably at fairly quick notice at the moment, is examining the representations that have been made, including fact patterns and policy wordings and so on, and obviously the insurers' own representations too. And what they've said is that they'll put forward the insured's arguments at the hearing to their best advantage. So effectively, the FCA is acting in the public interest on behalf of policyholders, even though the FCA has previously stated its own view is that most of the policies don't respond. Obviously, as a public authority, it has a duty to act in the public interest, so there should be no worry there. Finally, the most exciting as a barrister and nerdy lawyer aspect of this case is that the FCA has given a real commitment to making all the materials that it can do public, and it will publish all the pleadings on its website. And it has also said that it will publish other relevant material where it is able to, i.e. that doesn't conflict with a duty of confidentiality or litigation privilege. So really, it's a case of watch this space. The FCA, I think, can be commended for its swift action in this regard, and commended for taking what should be a fairly decisive step in determining whether or not, or having determined by the court, whether or not the vast majority of these policies ought to respond. Final point, the FCA bringing a test case does not prevent individual firms or individual companies, policyholders, from bringing their own actions, be that in the courts or taking, if they're eligible, their cases to the Financial Ombudsman. However, the speed at which this case should be resolved will obviously be helpful to all. Moving on then to the topic of Brexit, and I'll keep this fairly brief, although obviously we like a break from coronavirus to some extent, going back to Brexit, not necessarily everyone's cup of tea. The simple answer to whether COVID-19 has affected financial regulators' preparations for Brexit is that the impact of COVID-19 has been felt in a number of regulatory initiatives. There was a grid published in May 2020 by the Financial Services Regulatory Initiatives Forum, and that sets out over the next 12 months what the timing is for various new regulations being brought in by the Bank of England, PRA, FCA, and so on. Now, of the initiatives in that document, of which there were 80, 52, or nearly 2/3, were marked as having their timing having been amended for COVID-19. But Brexit-related initiatives were almost entirely unaffected, such as the onshoring of financial services legislation for post-Brexit, the FCA's approach to authorising and supervising branches of international firms, of which there'll obviously be a much greater number at the end of the transition period. To take a little sidestep for a moment, I'm just going to talk about the temporary transitional power. And that's a broad power to the FCA, Bank of England and PRA to give transitional directions which disapply or modify relevant obligations. This was brought in under the FISMA Amendment Regulations 2019. And in very general terms, pursuant to the TTP, the regulators individually or I suppose collectively if they wished, may apply effectively a standstill so that firms can continue to comply with pre-Brexit versions of the relevant regulations and obligations. They've been taking a coordinated approach to this, thankfully, and they've published some transitional directions already. However, these have not come into force yet, and during the transition period, they did not come into force at exit day, 31st of January this year. They've also announced that there will be no transitional relief in some areas, such as firms who are subject to MiFID II or EMIR reporting obligations. Now, the reason, possibly, and it seems to me, that these transitional directions have not yet come into force as a result of exit day, is because it seems the original approach of the FCA, Bank of England and PRA was to use these transitional powers, temporary transitional powers, in the event of a no deal situation. But on the 25th of March this year, so 2 days after lockdown was announced, Her Majesty's Treasury laid a written statement before Parliament, and I won't quote all of this quote here, but the key bit is the second paragraph, where HMT told us that the department will therefore retain the regulator's TTP and, the third line down, shift its application such that it is available for use by UK regulators for a period of 2 years from the end of transition period. Since then, all three regulators to whom this applies announced on 30th of April that they now intend to use TTP after the transition period, as previously communicated, in relation to exit date. That is, all of their previous announcements, of which, as I've mentioned, there have already been quite a few, they've said that they'll still use those, but in the way in which they would have done after exit day, now they will do so at the end of the transition period, i.e. the end of this year. There may be some further amendments required to FSMA as a result to ensure the TTP is available after 31st of January 2022, as in another sign, to my mind, that it was intended to be used in the event of no deal situation. Currently, the regulators may not make transitionary provisions after after 2 years after exit date. So it seems potentially to me that this is a manner of allowing some further flexibility in Brexit related regulations as a result of COVID-19. And with that, thank you very much for listening, and I will hand over to James.
Thank you very much, David, and I will do the same and share my screen with everyone. And in the few minutes remaining, I think I'm going to cover some issues relating to complaints to the Financial Ombudsman Service. And for those of you who are less interested in this topic, there is a not very well hidden personal selection of recommended lockdown reading in some of the headings to these slides. Some are heavier reading than others. But what I would want to consider is the potential effect of COVID-19 on making complaints to the Financial Ombudsman Service. And for that purpose, I think it's helpful to go back to the origins of the Financial Ombudsman Service just briefly. As everyone knows, a statutory ombudsman scheme, which was established under Part 16 of the 2000 Act, along with Schedule 17. And for those of you with longer memories or who've been working in this area for longer than others, you may well recall a variety of different industry schemes that used to exist. Old favourites such as the PIA, Personal Investment Authority, Ombudsman Bureau, the Insurance Ombudsman Bureau, the Banking Ombudsman, and the Building Society's Ombudsman. The purpose of just reminding you of those is just to give a flavour of how wide the consequential subsumed jurisdiction of the Financial Ombudsman Service now is. And the statutory objective of the Ombudsman Service was set out in section 225 of the Act. And in a rather beguilingly simple explanation or statutory objective, it stated that it is a scheme under which certain disputes may be resolved quickly and with minimum formality by an independent person. That, of course, probably now conceals the sheer number and scale of people necessarily involved in the Ombudsman to cover with the huge range of complaints that it now has jurisdiction over. And just to consider why the Ombudsman Service may be affected so significantly by COVID-19, it's just worth considering what its principal compulsory jurisdiction is. And that is governed by Section 226 of the 2000 Act. And the compulsory jurisdiction relates to complaints from eligible complainants relating to an act or omission of a person in carrying on activity to which the compulsory jurisdiction rules apply. And for your notes, if you will be familiar with this already, but one has to turn to the FCA handbook and the section DISP, being dispute resolution, DISP 2, which deals with the jurisdiction of the Ombudsman Service. Eligible complainants now include consumers, as it always did, but also micro-enterprises, charities of a certain size, trustees of trusts with a certain net asset value, and as of very recently, small businesses. And those are defined in the FCA rules, those with an annual turnover of less than £6.5 million, with either less than 50 employees or a balance sheet total of less than £5 million, along with guarantor individuals of micro enterprises and small businesses. And that extension of who may be an eligible complainant is obviously of particular significance in the context of COVID-19 and the way it's affected not just individuals, but also a large number of small businesses. There is also, coincidentally, at the same time, the extension of the powers to make a money award by the Ombudsman Service, as from the 1st of April 2019, for acts or omissions after that date. The amount the Ombudsman can now award is £350,000, which is a significant increase over the previous figures, most recently 160,000, and before that lower figures still. And one only has to consider the large corpus of areas that the Ombudsman covers to get an idea of how significant COVID-19 and complaints arising out of it can be. It covers PPI, banking and payments, consumer credit, insurance, mortgages, investments, and pensions and annuities. So then I turn really to what I've described as the heart of the matter of the Financial Ombudsman Service. I regard it as the beating heart of the Ombudsman Service, and that's expressed in Section 228 of the Act. And that is the statutory requirement for an ombudsman to determine a complaint made where it falls within the jurisdiction by reference to what is, in the opinion of the ombudsman, fair and reasonable in all the circumstances of the case. And I would stress the words "in the opinion of the ombudsman," because it's those words that have been considered in subsequent cases that, among other things, make it clear that it's for the ombudsman to decide what's fair and reasonable, and that involves subjectivity rather than a test of law as to what a court considers to be fair and reasonable, for example. And Section 228 must be read alongside DISP 3.6.4R, that's the rule number in the DISP FCA handbook. That requires that the Ombudsman, when making a determination and deciding what's fair and reasonable in all the circumstances of the case, must take into account a number of things. One of those things is relevant law and regulations. Another, relevant regulators, rules, guidance and standards. And of course that will cover FCA issue of guidance or changes in rules of the types that you've been hearing about so far. And also, the Ombudsman will take into account, where appropriate, what he or she considers to have been good industry practice, and in these words, at the relevant time. Any practicing administrative lawyer will be familiar with the principle of taking into account material considerations, but equally familiar with the principle that where material considerations have to be taken into account, it's for the decision maker to decide what weight to give to those considerations. And indeed, the decision maker is entitled to give no weight in an appropriate case as a matter of discretion. So those two provisions, one statutory rules of fundamental importance to understanding the way in which complaints need to be determined by the Ombudsman Service. They have been considered, of course, by the courts on a number of occasions. And what I provided for you on this slide is just a very short selection of some of the cases where that statutory jurisdiction and those rules have been looked at in some depth. And I just draw your attention to the IFG cases in 2005, where the first real consideration was given to Section 228. And the High Court in that case decided that it was clear that it did not require a complaint to be determined in accordance with the law. And that principle was revisited by the same judge, but who had since been elevated into the Court of Appeal in the case of Heather Moore in 2008, where the same conclusion was reached, but also analysed in the context of Article 6 of the European Convention on Human Rights and the principle of the rule of law. And the Ombudsman's jurisdiction under Section 228 as not requiring complaints to be determined in accordance with law was found to be compatible with both those additional features. And then the BBA case, the British Banking Association case, which concerned PPI and the FCA and the FOS response to PPI, the FCA in terms of its introduction of relevant rule requirements, and the FOS and the determination of those complaints, involved a consideration by the High Court of some important principles which, to my mind, are likely to become relevant to the way COVID-19 related complaints may be considered in due course. The High Court in that case decided that the FCA principles, which are the high-level principles governing all firms and businesses acting in accordance with the regulations, were the ever-present substrata of the regulatory framework, and importantly, were not displaced by more specific rules and guidance. So, for example, in that case, where one had COBs and ICOBs, those are relevant rules relating to conduct of business, in particular in relation to sale of insurance, the fact that one has more detailed rules and a firm may be able to say there's been compliance with specific rules does not mean necessarily that there's been compliance with the principles, including, for example, Principle 6, which is the requirement to treat a customer fairly. And then more recently, in the case of Barclay Burke, which concerned SIP administration or administrators and a potential liability in circumstances where they regarded themselves as carrying out execution-only type administration of SIPs, the High Court revisited the principles in BBA, but also looked at that principle of what was good industry practice at the relevant time under the DISP rules. And like BBA, made the point that there is a difference between common industry practice and good industry practice. The fact that industry practice may be prevalent, indeed in the case of PPI, it was very prevalent, it didn't make it good industry practice. And the other facet of that is that the DISP 3.6.4R itself requires the Ombudsman to look at industry practice at the relevant time, which of course discounts in principle the notion of hindsight. With that sort of background, I'll just come to some thoughts on what I've described as fairness in the time of COVID-19. The first point to note is that it seems to me there is bound to be an inevitable effect on complaints to the FOS in the various areas, and the FOS itself on its website has indicated areas of likely or whether likely to be effects, including of course loans and financial difficulties, mortgage payments, credit cards, Section 75 type claims under the Consumer Credit Act and chargeback transactions, business interruption insurance, of course, which you heard about in terms of the FCA's test case approach, travel or wedding insurance, and investments and pensions. At the, or on the FOS website, it's ago now, but there had only been received a handful of complaints related to COVID-19. But I just point out there's bound to be an inevitable time lag in terms of complaints coming to the FOS, not least because that the normal principle applies that consumers and eligible complainants should first complain, if they have a complaint, to the business to see if it can be resolved at that level. And there's an 8-week period for the business to consider it. And the FCA has already issued guidance to encourage patience on the part of complainants for that 8-week period in recognition of the difficulties of businesses having to deal with COVID-19 complaints in the current circumstances. The third point to note is that there have been an exchange of letters between the FCA and the FOS relating to COVID-19. And they're also on the FOS website if you want to see them. And it's in a sense a somewhat old-fashioned idea of exchanging letters, but you can see that it's still current, where the FCA as a regulator has set out a letter to the FOS seeking clarification or confirmation of the potential approach, and the FOS has then responded. And I don't really have time to take you through all of those letters, but the substance of the first 2 letters is the FCA expressing concerns on behalf of businesses that the FOS might not deal with COVID-19 related complaints in a way which recognises the need to avoid hindsight in the application, or in the case of coronavirus bounce back loan schemes or coronavirus loan schemes, not recognising the change or different regulatory standards that have been applied to those schemes, such as, for example, not having to conduct the same creditworthiness checks that would apply to a regulated credit agreement. And without taking you through the letters themselves, which you can read, which are interesting, what is significant is that whilst those concerns are clearly being expressed by businesses and the industry, the Ombudsman's response, as one might expect, draws on the statutory principles and indeed the rules to answer the point about concern about taking into account new regulatory rules and the benefit of hindsight. And as I've already illustrated, the rules are already well set up to require the Ombudsman not to apply hindsight. As you see in good industry practice is judged by what's good industry practice at the relevant time. And there is a requirement to take into account regulatory guidance. So that will include any regulatory guidance that's issued by the FCA, for example, or any other regulator during the current circumstances. There is also a letter written to insurance companies by the FOS on business interruption insurance, explaining that the FOS is aware of the FCA test case, but it's not clear what impact that would have on the FOS deciding business interruption insurance type complaints. It may be, the letter indicates, that there would be a pause of some complaints pending the outcome of the test case, given the need to take into account relevant law, but that's not certain. And on the other hand, in respect of complaints that can proceed, there's been a request for any further information insurance companies want to provide about policies, no doubt so that the Ombudsman can have an overall view. And there's an indication that there will be the potential identification of lead cases, which is a form of practice of just identifying cases that raise potentially similar issues rather than deciding all at one go, and just making some decisions which then provide some assistance on the general approach. Finally, just comment on what I've called a natural role for an unnatural event. Because for the reasons that I've already indicated, it certainly seems to me that section 228, subsection 2, along with the DISP rule, and indeed PRIN 6, which is the duty to treat one's customers fairly, already provides a natural role for consideration of complaints where they raise novel or difficult issues. And of course, there is some precedent or lessons that can be learned from the past, because whilst this is an unprecedented, certainly of recent generations, incident that's affected both personal lives and indeed financial services in an unpredictable way, there are some experiences from the past which indicate a robustness in the statutory scheme and the ability to deal with complaints that raise issues. And I've just given you some examples of those. The Bearing Fide, of course, is the duty of utmost good faith in insurance contracts. And it was the Insurance Ombudsman that led the way in consumer type insurance arrangements, in treating the application of the strict principle of the Bearing Fide, which allowed insurance companies to void policies for any non-disclosure, and softening that approach to look at questions of materiality of non-disclosure before policies would be voided. And that happened a long time ago, but by reference to principles of fairness. Mountaineers is a reference to Lord Hoffman's approach in this Samco case on the principles of causation. And as I've indicated in the IFG case, sometimes a strict application of the law of causation, for example, where losses occur as a result of fraud, may result in consumers not getting any payout. But in IFG, the court accepted that the Ombudsman was entitled under the jurisdiction to adopt a different approach, particularly bearing in mind that many lawyers themselves struggle and disagree on the principles of causation and foreseeability, as many of you will recall from hours spent studying the area. And then volcanoes, for just to refresh one's memory, it wasn't so long ago, 2010, when the unpronounceable volcano in Iceland erupted, disrupting air travel for some number of days, and there was a significant number of consequential insurance claims, travel insurance claims, many of which were deemed to fall outside the terms of the policy, but for which redress was paid both, I think, or required to be paid both, but indeed in some of the county courts, but also by the Ombudsman Service. And then finally, Plevin and PPI, there's an illustration of where the courts themselves have to sometimes grapple with concepts of fairness. In that case, the unfair relationship test that went all the way to the Supreme Court, and indicating that even the Supreme Court overturning the Court of Appeal could have different views on what constitutes fairness. But that, to me, rather illustrates why the statutory test that an ombudsman has to apply under this scheme is a fit and proper test to deal with such novel circumstances. But those are very much my own personal thoughts about what may happen from COVID-19 related complaints in the future, and we'll have to see how they are decided in due course. And I'm going to now stop by sharing my screen. And we've gone on a little longer than I perhaps anticipated, but there have been some questions that have cropped up, and I think I'm going to hand over to Gethin to answer two questions that have come, and then David to answer one about the FCA test case. So Gethin, I think the first question was whether the moratorium applied to LLPs, and also whether there has been any indication of the FCA attitude to delays in applications for individual authorisations due to inabilities to complete full paperwork. So any help you can give on that would be useful.
No problem. So the short answer to the first question is that the moratorium does not apply to LLPs. So the moratorium provisions are made by the bill by way of amendments to the Insolvency Act 1986. And what the bill will do will introduce into the part that deals with moratoriums a new section A52 on interpretation of the terms of that part that makes clear that a company, for the purposes of the moratorium provisions, means a company registered under the Companies Act 2006 in England and Wales or Scotland, or an unregistered company that may be wound up under Part 5 of the Insolvency Act 1986. So unfortunately, the moratorium doesn't apply to LLPs. and the bill also generally distinguishes in the remainder of its position between LLPs and companies. With regard to the second question, I'm afraid I personally don't have experience of the FCA's response in relation to particular instances of application, so I can't give an impression of the FCA's attitude as such. But what the FCA has done is issued a statement advising that it recognises that it may not be possible for firms to comply fully with the requirements for some important functions, such as the post and paper-based processes, in a timely way during the current crisis. And it states that where this is the case, it expects firms to notify them as soon as possible via a specific email address. So I would anticipate that the FCA would be reasonably accommodating, but I'm afraid I can't give any insights as to particular trends in their attitude. But I hope that's helpful.
Thank you. And David, there's a question I think which you may be able to help with or not, depending on the answer. But that is when, or if there's any indication as to when one can expect a decision on the FCA request for declarations in the test case. You mentioned, of course, a July hearing, which is what's been reported in the press, but do you have any idea when you think the declaration might result?
Well, the very short answer is no. But to give my thoughts on the matter, as already mentioned, the representations now in. What the FCA is now currently doing is deciding which firms to ask to join the case and which policies will form part of the representative sample. Certainly, to get a hearing on in July, given pleadings haven't yet been exchanged, would normally be quite ambitious, but the insurance industry itself may well welcome swift resolution of these issues. So we can expect anyone who is joining as an insurer to fully cooperate and make things as speedy as possible. I know the ABI has put out a statement saying it welcomes the case. What we're waiting to see is the pleadings, and that really will help us know a little bit more. Given that this will be a case which is on an agreed basis, we can presume that's on agreed facts as to any particular fact patterns which may affect interpretation of a policy. So it's essentially a contractual construction case only, and should only require submissions from either side. And we've seen how the courts can move quickly where there's cases of great importance, such as the Brexit decisions. Given that there would also not be any need for a long judgment on disputed facts and the like, you'd expect a judge to be able to deal with it quite quickly after the hearing. I'm speculating at this point, obviously, but I'd be very surprised to see anything more than a 2-day hearing, and then very surprised again to see the judge not deal with it within maybe 2 or 3 weeks. But obviously that's speculation only. And obviously we are getting towards August if there's a July hearing. However, at a best guess, hopefully we'd see something as a result of this process by September. And the best place to look, again, is the FCA website. They're being very useful in terms of their communication on this matter and updating regularly. And as I've said already, they'll be putting the pleadings up when available and so on.
Yeah,
So watch the FCA's website is my best.
Absolutely. I would just add to that that whilst I noted what you say about the prospects of an appeal, that the history indicates that sometimes these things can be more controversial, and I'm thinking of bank charges cases, for example. If there is an appeal for whatever reason, and that may well happen, then of course things become more delayed depending on how high the appeal goes and the processes for dealing with that. But thank you very much for that. There's been another question which I think I'll try and express a view on, and Gethin may want to express a view on, and that is to what extent or in what circumstances we think that it would be permissible for a regulator to renege on any aspects of the flexibility that they're given to regulated entities in any particular case. And speaking obviously in the abstract, but as an administrative lawyer, it seems to me that there would be limited scope to renege on that sort of flexibility. It will depend obviously on the specific provision or the specific flexibility that's an issue, but principles of fairness and indeed legitimate expectation in public law, where there's a direct expectation of a certain result which is clear and unequivocal, will ordinarily provide a safeguard against the public authority reneging on it from a regulatory perspective. But that, of course, somewhat depends on the specific thing that the FCA is reneging on, if that were to occur, because there's always room for dispute of whether so there was a sufficiently clear assurance as to what the position would be. But that's my initial instinct by way of answer to that question. I don't know, Gethin, if you have anything further thoughts on that.
No, I have nothing to add. Say that, yeah, I fully agree.
All right. Well, look, thank you very much. We've overrun considerably, but we've had some good questions, and I hope we managed to answer them. I very much hope everyone has enjoyed it. As I said, you can catch up on the website for the presentations and the webinar itself, which will be available tomorrow. But it just remains for me to thank David and Gethin, but also all of the people who've joined us this afternoon, and very much hope you've enjoyed it. Thank you very much.